All right, welcome everyone. Let's just dive right in because we are looking at an incredible set of data today that is literally going to impact your wallet, your savings, and your future. So what we're doing today is transforming the latest deep dive report from Augusta Global Insights into this highly visual whiteboard explainer. Look, if you've been standing in the grocery aisle wondering why your bill is climbing, or you're just sitting there wondering what to actually do with your cash right now, well, you are absolutely in the right place. We're going to break down this core inflation problem, we'll look at the brutal reality of the current markets, and we're going to map the whole shebang out for you right here. Now, just a really quick note before we get into the heavy numbers. What you're watching is an AI-generated explainer summary of the latest written report from Augusta Global Insights. So we highly encourage you to go read the full original article. You can find the link to that right down in the description. Our goal today is just to take these super complex macroeconomic trends and make them completely accessible and, easy to digest.
Okay, so here's our roadmap for today. We're looking at the inflation data surge, the pass-through effect, and the decline of purchasing power. From there, we'll hit smart ways to protect money, dive into the housing market gap, and then wrap it all up with our key weekly market updates. Let's get to it. Starting with Section 1, the inflation data surge. All right, I need you to put your Wall Street analyst hats on with me for just a second. Because wow, the sheer magnitude of this miss is staggering. Look at this. The May 2026 CPI came in at 3.8% year over year. That beat the 3.7% forecast. But honestly, look right below that at the PPI, the Producer Price Index. It surged to a shocking 1.4% month over month. They were forecasting just 0.5%. To put that into perspective, in the financial world, a massive unexpected leap like this is a huge bearish signal for the US dollar. Which brings us to Section 2, the pass-through effect. So why do we actually care so much about the Producer Price Index? Well, it's because it's the ultimate leading indicator. When manufacturing costs just absolutely skyrocket by 1.4% in a single month, what do you think the big corporations are going to do? Are they just going to absorb those higher costs out of the goodness of their hearts and willingly hurt their own profit margins? Are they really going to risk worse earnings and plummeting market caps?
Emphatically no way. Corporations exist to protect their bottom line. Right now, with Brent oil hovering around $100 a barrel due to all this geopolitical tension, manufacturing and shipping costs are just elevated across the board. So the simple, unavoidable reality here is that companies pass those higher costs directly on to you, the consumer. The inflation we are seeing at the producer level today, that is exactly what is going to cause a massive spike in the June CPI numbers tomorrow.
Moving right along to Section 3, decline of purchasing power.
Look, if you've been feeling a bit of financial anxiety lately, the math completely validates you. We've got sustained Brent oil prices sitting at $100 or more per barrel. Now, couple that with the explosive M2 money supply growth that the folks at Augusta Global Insights have been tracking so extensively. When you print money while energy costs stay sky high, it causes a steady, undeniable erosion of your disposable income. So even if your money is sitting safely in dollars right now, your actual purchasing power is dropping fast. It's like a silent destroyer of wealth.
All right, so what do we do about it? Section 4, smart ways to protect money.
How are the savvy investors positioning their capital to actually survive this? Well, on the left side here, your traditional quote-unquote safe vehicles, things like checking accounts, CDs, and even high-yield savings accounts, they're virtually useless against this level of inflation. The yield they offer is just so much lower than the rate at which your money is losing its value. The real protection right now, it's over on the right. We're talking yield-generating U.S. Treasury bonds. After that massive PPI announcement, the 10-year Treasury yield hit 4.5%, and the 30 brilliantly broke right past 5.05%. And we've got to look ahead here. Incoming Fed Chair Kevin Warsh's intended rate cuts? Those appear to be totally falling apart in the face of this sticky inflation. We are looking at the very real potential for interest rate increases instead. Augusta Global Insights looked at the historical data, and get this. If S&P 500 valuations stay elevated, your disposable income keeps eroding, and Brent oil climbs toward $150 a barrel during the peak summer driving season, we could literally see the 30-year Treasury yield rocket to an astounding 7% or even 8%.
Okay, shifting gears. Section 5, the housing market gap.
630,000. That is the number of excess home sellers currently in the U.S. market. Read that again. The U.S. currently has 630,000 more home sellers than buyers. Just let that sink in for a second. This is literally the largest gap in history. But wait a minute, millions of these homeowners are locked into, 2% mortgage rates from a few years ago? Why on earth would anyone give up a 2% mortgage in today's high-rate environment? Well, it really comes down to two specific reasons. First up, people are cashing out to capitalize on incredible long-term tax-free gains. We're talking up to $500,000 for a couple on a primary residence. I mean, that is a massive incentive. But the second reason is a bit darker. Inflation has squeezed people's discretionary income so tightly that they are basically forced to sell just to unlock desperately needed cash flow to survive.
And finally, Section 6, Key Weekly Market Updates. Let's do a quick rapid fire here. First up in the corporate world, SoFi Technologies just agreed to purchase most of the assets of the British fintech company Primary Bid. And honestly, this is a remarkably strategic move. It dramatically accelerates SoFi's expansion into global capital markets, and crucially, it enhances their ability to offer everyday retail investors access to public offerings. It really reinforces the view held by the analysts at Augusta Global Insights that SoFi remains for sure one of the absolute premier fintech players in the US right now.
And to close out the news, this comparison is genuinely mind-bending. On the left side, you've got the total market cap of one single company, NVIDIA. On the right side, the entire U.S. healthcare sector of the S&P 500, plus the entirety of India's stock market. NVIDIA's relentless growth, fueled by all these endless partnerships with data centers, software giants, and hyperscalers, has pushed its value higher than both of those massive entities combined. It truly illustrates a market without limits for the AI chip giant.
All right, that brings us to the end of today's deep dive. Again, just a reminder that this has been an AI-generated explainer of the latest Augusta Global Insights report. We covered a ton of ground today, from that terrifying 1.4% PPI surge to the 30-year Treasury breaking 5%, all the way to NVIDIA's historic market cap. Be sure to check the description for the link to the full newsletter, and definitely subscribe to the channel so you never miss these weekly breakdowns. I'm going to leave you with one final thought to ponder this week. With inflation stubbornly eating away at the dollar, are you actively taking steps to protect your money, or are you just letting inflation quietly eat it away? Think about it. See you next time.